Hey there, everyone. Happy Monday, March 30th. Awesome to be back. We had last week off as we took the family to the Disney World, which was awesome. We had a really good time. Great to be back here. Still kind of adjusting back to the time zone, but doing okay. And great to be back with you here doing the show. I tell you what, awesome to take time off, awesome to get away, awesome to spend time with people who remind you why you put in time and effort to do other things, but also really cool to be back. And hope you guys are all doing well. Luckily, nothing much going on while I was away. Honestly, I tried desperately to unplug. I did pretty well, but it was, I think, Thursday when we were in line for some ride, and I couldn't. I just felt my phone like you know melting a hole in my pocket, and sure enough, felt that downside rotation that looked like it might be coming, and sure enough, end of last week was not particularly good. What was interesting this morning was we had a decent open, and it sort of felt like, is this the kind of recovery? Apparently not. Generally risk off is the vibe I'm getting here, as I described with my market misbehavior premium members over the weekend. I'm seeing a lot more signs to think more risk off than signs to be encouraged and think risk on. In this kind of environment, a lot of times it's what happens when we have these counter trend rallies. And I will caution you right now, in case you haven't thought of it yet, some of the biggest up days you will ever experience as an investor happen during cyclical bear market phases, right? During big downtrends, you often have these big rips to the upside, right? These big one-day moves. Haven't really had one yet here that I can think of, but it's coming. Maybe as early as tomorrow, we get a big, bounce higher, and a lot of people get very excited about that. I will most likely not, because what I found is it often helps to take a big step back and reflect on the reality that we're making up lower lows and lower highs. At least as long as that's still the case, we're in a primary downtrend. With that in mind, we will talk about some of these market conditions and how they evolved today, how the Dow ended up in the green, but everything else ended up basically in the red. Why volatility is one of the more concerning developments that I observed last week, along with a lot of breadth indicators continuing to get fairly negative. We'll talk about the heat map and how a number of things actually bounced higher today, but these are things that have generally been moving lower. And we'll try to remember to do a 5-day heat map, because I think it tells you an important story to reflect on. Then I got a bunch of charts to go through together. So let's get to it, shall we? So here's what happened today. The S&P now down to 63.43. If you remember, if you've been watching our content, we talked about 65.50 as being the line in the sand. That line was broken. And as last week progressed, we accelerated to the downside. New downside target for me, sort of in that 6150 to 6200 range. I actually just put out a video on Stock Charts TV. I do a weekly show every Monday. And if you go to their YouTube channel, you'll find today's episode talks about an approach to that downside target and how I derived it and what it means. So I'd encourage you to check that out if you want to think more about potential downside. At the end of the day, downside targets are one of the, and same with upside targets. I think they're more for fun than for actual investment use. And the reason is because I think the way that the price gets from wherever we're at to some arbitrary target, that matters way more than we reach some magical number and then you'd expect some sort of turn. So for me, analyzing market conditions as we would get down to that level is going to be, much more important. Having said that, the S&P down just under 0.5% today. The NASDAQ composite down 0.75%. Mid caps and small caps all down pretty good. So again, the Dow, the only thing slightly positive today, and that was just in the last half hour we had that bounce higher. The VIX did move slightly lower today, but last Friday we finished just below 31, and today about the same. So with a VIX above 30, right? VIX above 20 for me is we're in a high volatility environment, usually more consistent with bear markets than bull markets. VIX above 30 means something different. This is an extreme volatility environment. This is where we are in a very small number of observations. If you go back over time, it's very rare that the VIX sits above 30 for any extended period of time. And if you look back at the time when it's done so, they've been pretty painful bear markets. And so the VIX sitting above 30 as it is right now, not a great sign for equities. Bonds, however, had a decent day. The TLT was up 1.33%. The 10-year yield, the long bond yield, the 5-year yield, all moving down pretty good. The 10-year yield's currently sitting around 4.34. The long bond yield just below just above 4.9%. So bonds and stocks have generally been moving together a bit here, but we're seeing rates come down today. Stocks down, bonds up, dollar up is a combination. I don't remember having a ton, at least before I went out on vacay last week. So the dollar index up about 0.5% again. I mean, when you look at across asset allocation and look for just good charts, look for charts in constructive patterns. The dollar and crude oil are the two most obvious examples, and then derivatives from that, things like energy stocks, which are basically tied to crude oil. I mean, those are the two big things that look pretty constructive right about now. So dollar continuing to move higher, as does crude oil. Gold flat today, silver slightly higher, copper up a little bit, but the real movement, not surprisingly, in the energy space, crude oil prices, the USO, which is a crude oil ETF, up 4.5%, natural gas down about 5%. Those have generally been moving together. So this is a bit of a sort of a bifurcation in the energy space. But gold flat. And so what's interesting there is I have a chart in a little bit looking at the dollar, crude oil, and gold. And you'll see dollar sort of rotating higher, crude oil accelerating higher, gold kind of holding steady, but not really breaking down anymore, but not really rallying along with the other areas of the commodity space. Bitcoin kind of chopped around a bit over the weekend in the upper 60s, currently trading around 66,500 and change. That's up slightly from where we finished on Sunday, that is, and Ethereum price is up as well. Most of the top 10 coins slightly higher. Most of these, including Bitcoin and Ethereum, are the two that I look at most consistently, well below sort of those levels where I've been talking about. You know, Bitcoin gets above like 75K. I think that's a pretty constructive breakout. Never really had that follow through. So I would say at this point, not there yet. All right, looking at the 11 S&P sectors, we have financials at the top of the list, up 1.2%. Communication services, the XLC, up 0.9%. Utilities, up 0.7%. Real estate, number 4, up 0.5%. The reason why I went through those last two, some defensive sectors here looking okay. And that's not the end of the world, but it's not great, right? So financials up the most, but if you look at the charts of financials, I was even looking for some, charts in the XLF that would be good to highlight here. I didn't find many, right? Because the charts in the XLF don't look particularly good. What's happening now is they're up today. The XLF's up today, but a lot of these have been going down. They're just having like a one-day bounce. So I would need to see a lot more to start getting really excited about financials, but worth noting they're at the top of the leaderboard today. Some defensive sectors, as I mentioned, utilities and real estate up there as well. On the downside, and this one hurts, technology down 1.9%. Growth stocks not generally constructive here. As we look at the market carpet here in a little bit, you'll see a lot of red in the technology sector. A number of them, sort of toying with the 200-day moving average, toying with support, most of them not holding that support. And the problem is the XLK is about a third of the S&P 500. So when that's down 1.9%, doesn't matter how many financials and utilities companies are doing well. Our benchmarks are going to be down. Industrials down 1.6%. I would say one of the biggest surprises, I would say, in terms of a disconnect between a clear market theme and clear performance, or I guess a clear macro theme and a market theme, I guess is a better way to say that. Macro theme being huge conflict in the Middle East, appears to be growing. A lot of speculation that more and more money will be spent on aerospace and defense. Those stocks have been rallying pretty good. Now that the conflict has really accelerated in the last couple of weeks, a lot of those names starting to rotate lower. At the end of one of my last shows, I think before the break, I talked about the XAR, Aerospace and Defense. Today, I grabbed one of those names. I forget it was Raytheon or GE or one of those. Kind of classic breakdown pattern. So those charts don't look particularly good, and that's where a lot of times when there's a macro theme and people talk about, okay, there's a conflict in the Middle East, I should own defense stocks. That logically works, but do the charts tell you that it's a good time to make that play? And that's where there's a bit of a disconnect here. So when in doubt, don't trust your hunch on what should work. focus on what actually is working. One of my former therapists called that shoulding all over yourself. We talk about what you should do or what should happen as opposed to what actually is happening and what you can do. So let's not do that. Energy down as well, about 1% here, despite the fact that crude oil prices doing okay. Looking at breadth here, pretty neutral, to be honest with you, skewed slightly negative in some cases, but New York Composite Index, I mean, we'll call that dead neutral, 48% up to 50% down. That's a coin flip right there. That's not too bad. On the S&P, a little bit better, 54% advancers to 45% decliners. In mid caps, you kind of flip that. So it really was generally a neutral day in terms of breadth. Of course, one of the big shifts we've recognized in the month of March has been a rotation from a decent breadth environment to a pretty negative breadth environment, particularly in short-term measures of breadth like the McClellan oscillator, stocks above their 50-day moving average. Those types of things have all rotated, to the downside pretty aggressively here. All right, to finish up, the Magnificent Seven and friends. Hey, Meta bouncing higher. Now, it's not a great chart, so let's be clear. Thursday and Friday, it literally dropped pretty aggressively. And I know there was the sort of regulatory announcement that was announced there that hit Meta pretty good on Thursday and Friday. So today, a doji candle literally within the range of Friday's close. So even though it was up 2%, this is a chart making lower lows and lower highs. Let's be absolutely clear about that. Amazon also retesting the February lows, bouncing higher today, about 0.8% on the downside. Broadcom really undercutting support, down another 2.4%. Tesla, which sort of bounced up to the 200-day, actually breaking down through the 200-day this week. I grabbed that chart so we could look at that. And NVIDIA, similar to Broadcom, moving lower. I mean, the problem with these with this particular setup is a lot of these names are large names with big weights in the Nasdaq 100, big weights in the S&P, of course. So those stocks being down are gonna weigh on the benchmarks pretty good. As a reminder, we are thrilled to be back live here today, broadcasting on Facebook, LinkedIn, YouTube, and X. Thank you guys so much for joining. I see plenty of comments in the chats on all those different platforms. So thanks for participating. Anytime a question comes in, drop it in there. I did see some comments early on, actually, right when I was firing it up, comparing my vacation last week to the Lou Rukeyser effect. I'm honored you would consider me on any level. I mean, he was up here in terms of his lasting impact on the industry. It inspired so many. But I have reviewed his work. I didn't follow his work when I was younger, to be honest with you. But boy, I mean, I've watched as much of that classic content as I can get my hands on. There's a limited amount online, but I found some decent sources for it, and he's one of the best. So I love that. He would go on vacation and the market would slide. Maybe there is a Keller effect. I'll let you know when the next vacay is coming. None planned, but probably something this summer. So I'll let you know. I'll let you know when my plans change. But having said that, I can see your questions on any of those platforms. Drop them in there when they come to you. At the end, I'll try to take a question or two before we wrap the live stream. All right, let's look at the market carpet here today. And what you'll see, this is the one-day change. So immediately I'm drawn to two areas of a concentration of the color red. These are two pretty tough places today: the technology sector in the upper left, the industrial sector in the upper right. Let's start with technology because, obviously the underperformance of growth has been a noticeable factor in the markets here in 2026, and just how much that's shifted. If you can remember back to like July, August, September of last year, even going into the fourth quarter, there were periods when a lot of semiconductor charts just remained quite strong and quite impressive. Just today, we see names like AMD down 3%, KLAC down over 4%, Lam Research down over 5%, AMAT down over 4%, Micron down another 10% just today. So obviously, there's a lot of weakness here in the semiconductor space and in technology generally. The problem is that is a huge weight. That sector is a third of the S&P 500. It's a significant weight and represents obviously a key market theme that drove the markets higher through much of 2025. Right, that AI trade appears to be less and less ideal, and a lot of these charts like Empower, like KLAC, like Lamb Research. I mean, they're very toppy patterns, right? I mean, that at the very least, you're seeing double top patterns. Like I would say LRCX is kind of showing you a number of them are now making lower highs in the month of March. And I think that's a noticeable change, right? LRCX making higher highs and higher lows into January. Then all of a sudden we have a double top pattern. So we're no longer making new highs. Now we're just failing to even retest the previous high, right? So those conditions are getting worse. Also, you look down at momentum, and I think another thing that's shifting with some of these charts is the whole range of the RSI is drifting lower, right? Here in the bullish trend in November, December, January into February, the RSI mostly above 50. Pullbacks, see the momentum still remaining pretty decent. Now we're seeing that shift. We're seeing sell-offs where the RSI pushes below 40. We're seeing counter trend rallies where the RSI doesn't get above 60. So this whole trend is kind of rotating downwards in terms of the momentum. And I think that's a concerning shift with charts like this. So, LRCX is still not that far off of all-time highs. I mean, we're what? I mean, we're not right. We're 20% below the all-time highs. That's not bad. I mean, it's not great, and this is a 20% move. So let's keep in mind this is a big drop. But from a technical perspective, like we're still testing this support, but arguably starting to break. And I think when these stocks start to fail to hold those recent lows, that's when things could that's when things can really accelerate to the downside. So LRCX, a good example chart to kind of review, to think about what's changed in that space. The industrial sector, again, this is one of those where I think you get into trouble if you think, wow, there's a huge conflict going on, so stocks like Raytheon should be doing well. That worked for quite some time until it didn't. And the problem is with charts like this, and I think you're seeing the same thing with AI, even if years from now these companies end up doing wonderful things in terms of revenues and sales and earnings, the problem is at some point the charts, which are based on future expectations and future margins, if expectations just get a little rich and get a little stronger than is justifiable, we can get a bit of a reset. And now we're starting to see, I would argue, investors just kind of going risk off and just kind of taking bets off the table is what it feels like more to me. So, this was again sort of a buy the rumor, sell the news. Buy the rumor when there's all this discussion, all these news headlines about European nations needing to spend way more on defense, and a lot of companies sort of coming up with these huge budgets for defense. A lot of these stocks had incredible rallies during that period. All of a sudden, a conflict actually happens where they're actually using a lot of those munitions that they would be spending money on, and all these stocks are starting to rotate lower. So from a technical perspective, a lot of these showing quite a bit of vulnerability, breaking short-term support. Momentum is what I would watch there to see if that rotates more into a bearish phase. And I would say for a lot of these, they kind of are. So a bit of a false sense of security, I would say today, when you look at the heat map, because it doesn't look that bad and you're seeing a lot of things in the green. I would say here's the real issue, right? If we take just to a 5-day heat map, this is where you can see what the market actually feels like, which is limited areas of the market really showing strength. Most things feeling pretty heavy, other things feeling kind of neutral. This is where you can see financials more as a kind of flat to slightly down in the recent week. You still see the downward moves in technology and in industrials and the big communication services names, but you are seeing strength in defensive and value areas, right? Like consumer staples, number of which had a pretty decent week. Energy, of course, which continues to stand out as one of the stronger parts. The materials sector, utilities, right? These are areas of the market all pretty good over the last 1 week. So whatever platform you use, I would encourage you on a heat map like this, experiment with some different timeframes. That can just help you really understand the context, right? And it's very easy to get drawn into just what happened today. For me, I think a big part of my process is to connect what happened today with the larger themes that I'm observing. And if you do that consistently enough, you see financials for what they really are. These are stocks making some bounces, but they're still not great charts, generally speaking. Right? I would say there's not a ton of really good charts in the financial sector right about now. There's a lot more that are sort of in a downtrend phase that are just starting to pop higher a bit. All right, that's it for the heat map. Shall we continue on and look at some charts? Before we do that, I do want to let you know I will be at the Money Show next week. I'm actually going back to Florida, so I probably could have timed that a little better with travel because I'm going from the northwest corner of the continent to the southeast corner. But hey, this is what we do, and this is when we plan family things around when family's available. I'm going back to Fort Lauderdale in about a week. I'll be speaking at the Money Show Masters Symposium in Hollywood. It's actually, I think, the first time they're doing an event in Hollywood, or if it's not the first time, it's been quite a long time. I'll be giving a presentation called Using Technical Analysis to Find Emerging Leaders. We're going to focus on relative strength. We're going to focus on scanning. We're going to talk about some of the ways I think you can still find opportunities in this sort of environment, some of the technical tools we can use to identify those. You can find more information about this event coming up in Southeast Florida at marketmisbehavior.com/money show, where you can scan the QR code that you see on your screen to sign up for that event. If you do attend the event, do me a favor and please come up and say hello at some point. Always a pleasure to meet someone watching the content, and happy to answer questions and all of that good stuff as well. And I hope you enjoy our discussion about technical analysis. All right. The daily chart of the S&P 500, as we can see, has now progressed. And when I went on vacation, we were testing that red area, right? That bearish zone. We'd been in the neutral zone here for a couple months. Remember, we had the traffic light set up with bullish over 7K, bearish below 65.50. And sure enough, on Thursday of last week, I think that was the day, right? And I would say, other thing to know, right? I mean, just look at what's happened here with a number of these counter trend bounces, right? I mean, I'm seeing clear signs that we've gone from buy the dips, which is what sort of was a motivating approach here in the second half of last year into the beginning of this year, to now sell the rips, where you're selling short-term strength. And we can see examples of that with these shooting star candles, like this one, which was a couple of weeks ago. I think this one last week. So this was what, Monday of last week, where we opened up, traded above the 200-day moving average, but closed back below it. I mean, just think of what the dynamics of that day meant, right? We're getting back above the 200-day, which, if buyers are going to be coming in, that's kind of the time where I would expect them to start being really excited. That's not what we saw. We saw investors instead taking advantage of that short-term bounce and selling out and applying more selling pressure to the market, causing the prices to go down. So when we have these short-term rallies and we have these candle patterns, like a shooting star candle right at a 200-day moving average. And that really speaks to the investor psychology we're working with here. So that's Thursday and Friday. Here's today, again, closing in the lower half of the day. The RSI is oversold on the S&P 500. You have to go back to like April and May of last year for the last time that the RSI was oversold. I think it was at the April low. We were also oversold at the March low of last year, which ended up being a brief counter trend bounce to the 200-day moving average before we ended up going down to the April low. Go back on that chart and you'll see exactly what I'm talking about as a potential analog to what we're seeing here. So what does it mean when the S&P is oversold like we see right now? That often means we get some short-term bounce coming here pretty soon. And that's what I was talking about. Counter trend rallies, they're going to be sudden, swift, and seductive. Those are the three things that's not true. Sudden, severe, and seductive is what I usually say. Sudden meaning they usually come out of nowhere, right? It's like everything's bearish and all of a sudden the market just bounces higher. So they happen very quickly. They're severe in that they're usually not just brief pull. It's like a severe move to the upside where all of a sudden the S&P's up like 2-3%. And they're seductive because a lot of people will be talking about a lot of bullish stuff on that big up day. And again, my experience has been the biggest up days I've seen as an investor have been in bearish markets where you have these big counter trend rallies. And so that's why I think it's important to take a step back, focus on momentum, focus on, making higher lows, like signs of accumulation, not just signs of a one-day reversal. The fact that we're oversold means a one-day reversal, that kind of move could certainly happen. If it would happen tomorrow, for example, the 200-day moving average, I think, is a really logical place to think about an upside level of resistance. Getting back above the 200-day on stronger momentum, that'd be pretty bullish. But until then, I'm more inclined to think bearish. One of the tricks I often, use when I'm coaching investors and coaching analysts on using technical analysis is a classic approach to flip the chart over, right? So if you're looking at a stock that's starting to roll over and you wonder whether you should be selling it or not, flipping the chart over and just thinking, does this look like a good buy candidate? Now, we can kind of do that by looking at some of the short ETFs that are out there. So this is the QID, which is the ProShares Ultra Short QQQ. So buying this basically is a downside bet on the NASDAQ 100. So look at this chart, and the question is, does this look like the kind of chart you'd probably want to buy? I don't know about you, but it's looking pretty good right now from a technical perspective, because we made a pretty clear test of support here. We've now rotated above interim resistance. We're back above the 200-day after being below it since the end of April. The RSI is moving more to the bullish range. So this is really, I mean, I would argue from a technical perspective, pretty encouraging chart, just starting to break out, just starting to emerge. And the bad news is that's basically the QQQ flipped upside down. So if you're struggling as to how bearish you'd want to be in this environment, this is one of those charts. This is one of those examples that I think is helpful to consider humbly. All right, let's talk about some of the breadth conditions and where we're at. We talked about how the RSI is oversold right now in the S&P 500. There are a number of breadth indicators that are getting down toward some pretty extreme negative levels. And what that often represents is an opportunity for a counter trend bounce, even if there's still more of a downtrend. I'm not seeing signs of capitulation yet in the charts that I'm working with, but I am seeing signs of short-term bearishness that often leads to some sort of contrarian bounce. We're down to around 21% of the S&P 500 members that are above their 50-day moving average. That's down from around 75% about 8-9 weeks ago. So that's a pretty big rotation, with pretty much almost all of the S&P 500 breaking their 50-day in February into March. At this point, though, with less than 30% there, we can see previous times when we've gone below 30% and then break back above there. And it's often a bit of a bounce higher. Like here, for example, in January of 2025, we had that. Let's say about a month or so of higher moves before we eventually continued the downtrend, initiated a downtrend from February into April. So this is one of those times where the breadth is in some ways so bad it's good. I promised I'd keep the Zweig breadth thrust on here. I almost deleted it today because I would say the chances of us getting a completed Zweig breadth thrust are pretty low. It's still possible. We would have to have a remarkably strong rally in the next couple days, so between now and Friday. And Friday's a holiday for the Good Friday, going into the Easter holiday. And so, we've got 4 days in this week, 3 more days to push above 62%. Is that possible? It definitely is. We would have to have a huge breakout over the next couple days for that to happen. So it's looking less and less likely that a Zweig breadth thrust occurs. And if you look back, these are the previous examples of the Zweig breadth thrust. That's where you have really negative breadth that reverses to very bullish breadth in a very small window of time. And unfortunately, it looks like that window is going to expire before we have a chance to get very positive breadth. If it changes, we'll definitely keep you updated. So keep watching. We'll let you know. But for now, no. Here's another breadth indicator that's down pretty heavily. The NASDAQ 100's bullish percent index just touched 30% today. This is a breadth indicator based on point and figure charts. Basically looks at the NASDAQ 100 members and asks the simple question, is the most recent signal bullish? And if the answer is yes, that's a positive, that's a thumbs up for the bullish percent. And so 30% of the 100 stocks in the NASDAQ 100 are currently in a bullish formation, which means 70% are bearish, which is pretty negative. However, if you look back on this chart, for every time that the indicator gets down to at or below 30% and then starts to move higher, those have been pretty decent bounces in the price of the NASDAQ 100. Even if it wasn't a sustainable rally, even if it was just a short-term rally of a couple weeks before the downtrend resumed, like we saw in March of 2025, it's where counter-trend rallies kind of happen. So with these breadth indicators so negative, I'm kind of primed to think maybe we get a counter-trend rally within the downtrend phase that I would argue is still very much in place. We'll see what happens. The volume has not been great. And, as I was reviewing the charts, I started looking on the flight home on Friday, actually, and then over the weekend for my premium members, getting a weekly report out and just reflecting on what happened last week. One of the biggest shifts I think I observed looking at the evidence, was a big surge in downside momentum. Thursday and Friday were the biggest examples of that, where we closed near the lows of the day and we had above average volume. That negative volume pattern puts the Chaikin money flow well below zero. And this is an indicator created by Mark Chaikin, where you have a 1 month look back and you basically just look at the volume weighted by the daily closes. And so what it means when the Chaikin money flow has gone from very positive to very negative just in a couple of weeks, in 3 weeks or so, it's just there's a lot more distribution. We saw a ton of accumulation in February into March. Even though the market was going down, there were still decent accumulation signs from February, and that's really starting to shift. So until that volume turns more positive, I would say it's speaking to serious distribution in a way we haven't seen since probably second quarter of last year. The VIX remaining elevated here would be a real warning sign. Last significant drop, or last time the VIX was above 30, was at the April 2025 market low, and it was going into that low when the VIX spiked above 50 on a closing basis. This is something to be looking for, to see if it remains above 30. 29 is that green level, green line that you see on here. That was the folks at Ned Davis years ago were sharing some of the research they'd done on previous VIX signals. And in their analysis, the VIX above 29 was a big warning sign. Those most major corrections had that feature. And so they found that that was one of the most concerning developments were there. And that happened through the course of last week. So clearly the evidence has been bearish. So what's looking good? The dollar, number one, the dollar is currently testing just above parity, which is a 100 level. 100 is where the dollar index topped out in July of last year and also November of last year. We pulled up to that level in March. We've now pulled back to 99 and currently trading back above 100. So the trend from late January to late March has been quite strong. There's not a lot of charts that have that nice consistent uptrend over the last 2 months like we see with the US dollar. So, and that part of that is the dollar strengthening. I would say a much bigger part is a lot of the European currencies weakening versus the dollar, given the conflict that's happening, of course, in the Middle East. And again, the headlines there can obviously shift as we've seen from day to day. So I think this is where the charts can be helpful to just sort of see what investors in aggregate, how they're pricing in potential outcomes and potential economic impact. For now, stronger dollar is one of those clear signals that we've seen over the last 2 months. Obviously, crude oil prices continue to move higher. Crude oil today getting up to around $105 a barrel. That's a new closing high here for 2026. We continue to see that, and from a technical perspective, as a strong uptrend phase. Crude oil above 100 for an extended period of time usually causes some economic anguish in different ways. We'll see when earnings kick off in about 2 weeks how much companies are talking about crude oil prices and inflation and all sorts of other things and the strength of the dollar. But for now, that's the trend that we're observing. Gold, not too bad. Gold's kind of hanging in there. Spent the last week right around 4,500. So if there's one positive message, as stocks were selling off aggressively into the end of last week, while gold didn't rally significantly, it also didn't go down. And so while stocks had a pretty rough week, gold had a kind of flat week, as did silver. And I would say that's a good sign. And it speaks to the fact that there's a fairly low correlation between gold and stocks. And I think that low correlation appearing to hold here. All right, let's talk about some individual stocks here. Apple closing below its 200-day moving average for the first time since August of last year. This is represented, I would say, a pretty broad kind of topping pattern that we've seen with Apple. Most recently, we highlighted this coil pattern, which resolved to the downside at the beginning of March. From there, we've continued down to the 200-day moving average where we bounced. And then it appears like today we are failing to hold that one. If we get follow through tomorrow, particularly through that first Fibonacci level, that would also mean a break below the January low. That's around 242. So Apple below 242, pretty bad, pretty scary breakdown. For now, we're having that initial breakdown through the 200-day. We'll see if that's confirmed on Tuesday. Tesla, unfortunately, and other Magnificent Seven names have already broken down, have already had that confirmation. Tesla, for example, broke down through the 200-day, rallied back to test that 200-day from below, and then rotated lower. And that pattern, that general phenomenon of a breakdown and then a retest of the breakdown level and a drop is also seen on uptrends, right? We'll see a breakout, a pullback to the breakout level, and then the next leg higher. That happens all the time where breakout or breakdown levels are retested in the next leg. So I think that confirmation from Tesla really just solidifies the fact that Tesla's in a bearish phase here. The fact that the RSI has been below 50 almost the entirety of 2026, not good either. Palantir, I saw in the chat earlier, someone mentioned Palantir. So I popped this chart in here right before we started. Palantir fallen off the radars after losing 150. It appears to be headed to 120 in a hurry. Josh, thanks for posting that comment. Yeah, so these swing lows are right around 125 on an adjusted basis, which looks like a pretty interesting level to watch. You'd mentioned 120, and I hear you. For me, I see this again similar to the chart of Tesla. This is what's happening here, right? The breakdown. You have that initial breakdown. We have even here sort of that retest, and then a failure, and then another retest, and another retest. Look at these number of times where we've hit the 200-day. And the fact that we can't gain a foothold above the 200-day, the fact that the RSI doesn't get above 60, that just all screams bearish rotation to me. And so now we're rotating lower. I think a breakdown below 125 that would clear that swing low from February. I think would be a concerning breakdown in my book. The lack of upside momentum, I think, is most important to watch there. Thanks for highlighting that name. GE Aerospace, I mentioned last time we did a show, the XAR, which is an aerospace and defense ETF, kind of a double top pattern, then a breakdown. GE Aerospace actually made a new all-time high at the end of February, but now it started to rotate lower. I mean, look at the difference from strong February to a very weak March. We're looking to finish the month tomorrow at the lows for the month, and we've broken down through the 200-day moving average. So again, this is one of those where I feel like even though aerospace and defense feel like a great theme and the macro theme, hard to make an argument against it, but are the charts telling you it's a great place to park your capital? And I would argue at this point, they're not making that argument very well. The RSI is fairly weak. Similar to the S&P, we're in an oversold condition, which often means we get some sort of counter trend bounce here, in the short term. However, I think that 200-day is important. I think charts like GE regaining their 200-day, if we do have a bullish resolution to this whole thing, that would be one of the bullet points on a reasons to be bullish again list, I would say. Pfizer, right? So let's talk about charts that are actually looking constructive. I only have one to share with you today. There's a lot of crude oil and energy-related names that are looking pretty good, right? Charts like Chevron are good charts. I'm highlighting Pfizer today. Pfizer's got a pretty decent dividend. And what's happening right now is it's actually testing a 50-day moving average from above over the last couple of weeks. There's just very few charts that look like this, right? Pfizer looks sort of different. This is a stock that's breaking above resistance and pulling back to test that breakout level. It's pulling back to an ascending 50-day moving average and holding it. Most stocks are breaking down through the 50-day. And matter of fact, many of them, as we've highlighted some of the growth stocks today, breaking down through their 200-day as well. So a stock that's holding an ascending 50-day moving average where the RSI is consistently above 40 and often above 50, where the relative strength is making a new 3-month high, those are the types of charts that are great places to be. And I would say out of all those things I just mentioned, this line at the bottom, the fact that Pfizer is helping you outperform so far in 2026 for Q1, charts like this, where the relative strength line is going up, that means you're doing better than the benchmark. That's the way you navigate a period of market instability. I would argue focus on relative strength, focus on stocks showing some decent strength out there. All right. We'll take a question or two. Studio RV8. Thanks for watching live on YouTube. You asked, has the Hindenburg omen fired again? So the short answer is no. And the somewhat longer answer is I'm not paying a ton of attention to the Hindenburg omen anymore, only because, right, the Hindenburg omen comes into play only in certain conditions, right? What you have to remember is the Hindenburg omen is looking for a very particular set of circumstances that it was designed by reviewing a bunch of previous market highs and saying, what were the consistent characteristics there? So, factor number one, there's a couple, checks that are made to create the signal. And the very first one is the market has to be in an uptrend. And the way that was measured, according to the creator of this indicator, is that the 50-day rate of change on the New York Composite Index has to be above 0, right? So we have to be higher than we were 50 days ago, about 2.5 months in market action. That black line right there represents the rate of change on the S&P. This horizontal line is the 0 line. So now that the 50-day rate of change on the New York Composite Index is negative, the Hindenburg moment actually can't fire until and unless we get back into an uptrend. So the signals that occurred in January into February, like that's it. That is, I would say, a pretty good sign of market topping conditions. The fact that March has been as painful as it has been since that signal, I would say, is a great validation of the fact that that it's pretty strong. Maybe one of the things you're noticing is that we had a lot of new 52-week highs and new 52-week lows today, which we did. But the problem is because the New York Composite's already going down, it's like the Hindenburg movement's not looking for the signal anymore. I kind of think of this as like the initial test. Like if the market's not going up according to that definition, there's not even something to worry about. So until we get some sort of upside turn that would cause the New York Composite Index to be back in an uptrend as defined by that comparison, can't have a Hindenburg Omen signal anymore. Again, I think the ones, as someone said, it spazzed out in February. I would not use that particular phrase, but I hear you, and you're right. We had a lot of signals there in the month of February. I think those were pretty fair. A person 1181. I love your somewhat anonymous handle. Good afternoon. How are you positioning in this environment? So I have a number of different, portfolios that I'm running, kind of friends and family stuff. I don't really run outside money of any sort. I have zero interest in doing so. I enjoy talking about the markets and managing my own portfolios, and that's about where my relationship with managing money ends for the most part. Having said that, for me, I kind of have a number of different accounts that are running different mandates, but generally I think of just risk on versus risk off. And in the portfolios that I'm running, particularly the larger accounts, like am I tilting more toward risk on, where I'm taking risk, where I'm putting money in equities and crypto type of things and ETFs and trying to bet on upside and betting on capital growth? Or am I going risk off, where I'm focusing more on capital preservation? And my portfolios have very much been tilting over time and in different ways toward defensive positionings. I'm about as defensive as I get at this point, I would say. I have way underweight an equity position. I still own some equities, and I always do in some way, but it's more defensive plays, and it's a much smaller percentage than normal. And so for me, I'm probably as risk off as I generally tend to get in portfolios where I move them based on my market trend model. So that generally means defensive areas of the market, areas of the market still showing strength. So things like energy and some of the charts certainly that we highlight here for sure. Folks, that'll do it. I did get some other questions. I don't have time to answer all of them, but the ones I did not get to, I will put them into the mailbag, and maybe we'll feature them in our next mailbag episode. Markets are closed on Friday. I'm probably going to end up doing a mailbag episode, though, just to get something out there and answer some of the great questions I'm already seeing this week. But for now, I'll say thank you so much for joining me. Great to be back here live. Thank you guys for being patient and not losing it when I took a week off. It was great to unplug. It was hard to unplug. But I came back refreshed and pretty happy to do the show. So good to be back with you. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.